We're looking at the hits and misses of Torpedo Tuesday for 2018. The man who walked us through this was Hugh Dive from Analysed Funds Management. Good morning, Hugh. How are you?
Good, Chris.
Now, we're looking back for 2018, and that year we saw 31 different companies and IPOs where we discussed their characteristics and investment metrics. And it's very unlike physics. It's an inexact science, that's investing. And all investors have to make decisions where they don't have all the facts, and the process is complicated by wild swings in human emotion that influences the overall stock market. And I think it'd be fair to say that's something that was a large factor in 2018.
Very much so, yeah.
Now, at some point, most of us would have made a great decision to buy or sell a stock and then see that stock fall or rise significantly just on market sentiment. So for 2018, that was a market where index funds were they had massive redemptions, and the index fund managers were just mechanically selling everything in their portfolio to the proportion that they held. And it's a real example of selling that was heedless of any individual company's investment metrics or outlook. So that was very strong to the late part of 2018. We've now come through, we've had reporting season and a few other things to give us reflection. Now, with all of that disclaimer of 2018 in mind, we're calculating that we're looking at the total return, so the capital plus dividend from the date that the Torpedo Tuesday looked at it, and we're comparing it against the ASX 200 total return. So that's the background. We're looking at this in review. Let's start with the biggest misses, Hugh. Where do we go there?
Well, thanks. Yeah, so it's quite an interesting exercise, like going through a report card. Inevitably, you'll have successes and failure in investing. It's part of the whole process. As you mentioned before, it's a somewhat inexact science with things coming out of left field. So probably one of our biggest misses was in March 2018. We're cautious on BHP. So since then, BHP has gained 28% versus the index 11%. So the thought process behind being cautious, we were seeing in the first half of 2018 the iron ore price weakening. We're concerned about the impact of a US-Chinese tariff war, and what does that impact on iron ore demand, and does that result in a sort of a dividend cut and weaker earnings for BHP in 2019? This was wrong. So we got it wrong in terms of the pricing. I mean, the underlying thesis we still see intact, but what happened is that BHP sold their US shale assets in July, and that was for a pretty good price. Oil price was up quite high, and that was returned to shareholders in terms of a buyback and special dividend. And this sort of short-term sugar hit pushed up the price from the March lows. And additionally, in 2019, something which we didn't foresee was a dam collapse in Brazil in late January. And that really pushed the iron ore price up sort of close to 20%. Sitting here in March 2019, it's starting to come off, but in terms of the report card, that was a big miss there. Sort of being, it should have been much more positive on BHP.
In hindsight, we can definitely see what went wrong there, and while the rationale seemed right and the thesis still was right, the market sentiment and the external forces drove that share price.
We could never have expected the Vale dam collapse in late January. That was just sort of quite a small mass. So in terms of the iron ore that's impacted, it's only about 20 million tonnes. So in the context of a 1.5 billion tonne seaborne iron ore market, it's somewhat a rounding error, but sentiment pushed up the iron ore price 20%. So we got that one wrong.
And if we move to another large miss for the year, in September 2018, we're looking at Unibail Rodamco, Westfield, and you can tell us the rationale behind being positive on Unibail there.
Okay, well, the tail of the tape's not so positive. So since we recommended this, or we were put a positive call in September, Unibail has fallen 16% versus the ASX 200 has gained 3%. So the rationale between being positive is we like the scarcity value of Rodamco's high-quality retail assets, which generally attract higher rental income and lower vacancies than their competitors. They had a good pipeline in the US and Europe, and sort of new sort of centres such as the World Trade Centre in New York. We're going to deliver some sort of medium-term growth. Additionally, for Australian investors, we like the total exposure to offshore earnings. We've seen the Australian dollar fall and against both the euro and the US dollar, which sort of boosts earnings and dividends, and also provides a bit of diversification benefit away from the Australian economy.
So that seems like a reasonable thesis, but where did it go wrong? Where did the wheels fall off?
The wheels somewhat fell. I'm not entirely sure if the wheels have fallen off, but the price has not been sort of positive. I mean, one of the problems with this stock is since Westfield were bought by Rodamco, it's not covered very well by the Australian analysts. Generally, they're not covered at all, or covered by sort of juniors. So what we saw in February, that was off 10% on results day. Despite sort of management repeatedly saying that they're going to sell some non-core assets, so to reduce debt, such as office buildings in Paris, and some shopping centres in Spain and Finland. And some analysts, which we saw, had in their models the debt reduction and declining interest costs without the corresponding decline in earnings. You can't have it both ways, collecting rent on sold assets. So when URW gave guidance for 2019, these same analysts sort of downgraded their previously wrong earnings, and that caused a big sell-off when the results came out in February. I mean, looking into this results, I mean, it's probably not a bad idea to be sort of selling down assets. Remember that Rodamco took on a fair bit of debt to buy Westfield, but they're being a bit more aggressive, so they're moving their gearing down from sort of 40% to 33%. Overall, we quite like it, but they're sort of taking advantage of sort of high asset prices, despite the fact their debt costs are extremely low. So the average debt cost is 1.7% with a sort of long dated, over 7 years maturity. So selling these assets through 2019 will take we'll have an earnings hit. But critically, sort of during the transition period, URW are committed to maintaining their dividend at 10.8 euros a share. And for Australian investors, it's quite happy to own the stock on a PE of 11 times with a dividend yield of over 7.5%. I think you can't find that sort of metrics anywhere else in the market, especially with the lack of exposure to Australia, with that upcoming sort of further political instability, change of government. I think owning companies with sort of offshore earnings is a good place to be.
So we've got that buffer of the offshore earnings. They're selling assets at higher prices. They're buying back debt effectively at low prices. And it would be fair to say that the wheels didn't fall off. If it was a good buy before when you looked at it in September, what are your thoughts now on it?
I mean, our investment thesis has not changed.
Right.
It's nothing's fundamentally broken, just the price came off. And we do see this when sort of analysts downgrade a stock. There's a lot of sort of quant and hedge fund we tend to automatically sell based on those sort of downgraded earnings. Looking at the previous earnings weren't right. We knew that, but it's the market did not sort of see that.
And then we moved to the biggest hits for 2018. So
more pleasant than running through one's failures.
That's definitely an easier conversation to have.
Yeah.
And we can't escape the Royal Commission for 2018. AMP was supposed to buy for that terrible media and things that happened in the financial services world.
Yeah.
Atlas applied the quality filter model to AMP and went from owning it to selling it. So what was the rationale there?
Well, yeah, so this is a live example. So we owned a reasonable position in AMP in early May in 2018. It had already fallen sort of 10% since when we bought it, down to about sort of $4.50. So it was a bit of a tough decision, but sort of having run through the process is what the process is, and you have to. One of the key parts of our funds management is being disciplined. So we sold out in May 2018 and also did as part of a Torpedo Tuesday at the same time. So since then, it's gone from bad to significantly worse for AMP. AMP has fallen 38% versus the ASX 200, which is down 4% over that same time.
Definitely a huge difference in the performance there. When you were about faced on the rationale, we touched on this on Torpedo Tuesday. If you can just slightly look at the rationale there and then what you got right.
Well, I mean, when we were sitting here in May last year, I mean, the revelations coming out of the Royal Commission, we spent a lot of time analysing AMP, speaking with industry contacts and trying to map out the potential outcomes and what this means for earnings. And given the uncertainty there, it was hard to sort of map out how this ended up for AMP and how this ended up being a very positive thing. So, I mean, the key reason why AMP was in the portfolio was the potential of a capital return to the AGM in late May 2018, and the positive exposed AMP was into rising rates. But these seemed both insufficient to outweigh the uncertainty around the Royal Commission, and obviously the capital return was never going to happen due to the fire that the AMP was under, losing sort of select sections of their board and senior management team.
So we definitely, and we also looked at the buyer of last resort, which impacted and got a lot of headlines, and that helped exacerbate the flow of share price downwards.
Well, I mean, one of the key things about that is that the buyer of last resort contracts, they're rumoured to be anywhere from $1 billion to $1.5 billion. That puts AMP in a very tricky capital position if those things are being exercised. Whilst AMP rebounded in February with the news of the Royal Commission, I think this story is still far from over. Whilst it's fallen close to 40% over the last sort of 9 months, it's very brave fund manager to invest in this company right now. Fund flows are sort of accelerating post the Royal Commission, or senior management team has departed. So we sort of got this one right, but at the time it was quite a painful decision. It did actually involve crystallising some losses. And
another one where the quality filter model worked well was Boral. So we're looking at June 2018. Boral fell 21% versus the index up 4% over that same time frame. So what was the rationale behind Boral?
Well, in June last year, looking at what we saw, Boral has been quite expensive. At the same time, the housing market was weakening, and they also sort of geared up going into the peak of a housing cycle. This is being a long-term analyst of Boral and putting on the sell side. This is something I saw them do in 2007. We had some concerns about them overpaying for the Headwaters acquisition. So yeah, it failed the quality filter.
And what was it that you got right? So
it's probably a bit early to tell, though. Sort of sitting here in March 2019, this is going to be a bit clearer. I mean, what we've seen is they had a weak Q1 2019 update, which was given in October, which was blamed on bad weather. That saw Boral being sold off heavily. The company then downgraded earnings in February, especially from the US gypsum venture. And looking through the numbers and the results, which I think a lot of other people did early in February last month, you see that Boral will have to have a very strong second half of 2019 to make their numbers. That's going to be quite sort of challenging. So in that situation, I mean, sort of going into a declining housing market, both in Australia and the United States, this is, so the stock price has fallen off, so we've got that one right.
And other ones that we got right were the IPOs. So we looked at Coronado Global Resources, that's down 19%, and then Vital Harvest down 10%. So we just have a look at Coronado to start with. What was the rationale behind that one?
Well, the key thing there was the coal price. We used a much more conservative coal price, and saw that was going to be a big determinant on Coronado's earnings. And while sort of at the current coal prices, Coronado would have free cash flow around $400 million today. On a more sort of normalised coal price, that goes down to sort of 180, and that would sort of place sort of Coronado in a bit of a solid, unspectacular free cash flow yield, about 5%. Whilst we sort of were comforted by the vendors retaining sort of 70%. This company was a very recently thrown together company. One of the key assets were bought off Wesfarmers. It seemed to be an IPO that was sort of was very much sort of put together at the peak of the market, and since then it's sort of very struggled. Additionally, you've got that sort of 70% holding from the private equity owners, which is a big sort of overhang. Yeah, this is was one to avoid, and it was a good one to avoid, with it down 19% since the IPO.
Now, Vital, Australian investors have seen strong moves from agricultural companies over the last few years. So you kind of think of having a conservative slice in the market as a reasonable investment. How did that play out?
Well, Vital looked okay up until sort of early 2019. So this was outperformed in 18 when it was listed, but somewhat come back to earth since then. So When Vita was listed, it was priced at a premium to the underlying LPT index. And whilst it had some interesting upside from growing berry consumptions and exports of citrus, some of this upside was very difficult for us. We found very difficult to quantify halfway through last year. Looking in 2019, previously, sort of, as I mentioned, vital harvest was a miss, but it switches to a hit after falling 6% in 2019. After the citrus variable rent was much lower than expected. Part of this was we talked about when we did
Torpedo
Tuesday, that it wasn't just the rent from the underlying agricultural assets. You, as an LPT, you're also taking some commodity risk in that a big portion of the rent is subject to the realised prices on citrus, on the citrus orchards. So in the back end of 2019, the first half of 2019, that variable citrus rent was about much lower than people expected. It was down 30% on the first half. And I mean, which is the big concern is that when this was listed in July 2018, the average citrus price was 30% above its 5-year average and over 130% above where it was 5 years ago, which took the view as like most investors, including myself, sitting in Martin Place, had difficulty forecasting the citrus price, and it was obviously took the view also that the Costa Group have been in the agricultural space for sort of 50-odd years. They know it better than me. When they're deciding to sell, it's probably not too smart for me to buy from them, and that's proved to be correct so far.
So looking at Vital and Coronado, it may be too early to make a really bold call as to whether it was really right or wrong, but early evidence is suggesting that these two were good ones to avoid.
Yes.
Now, if we look at the gyrations of 2018, there was a lot of volatility, and the last half of the year, particularly last quarter, was very heavy. So we went from seeing Seven West Media, that was early Torpedo Tuesday in April. It went from the quality filter model being wrong to right. So how did that come about?
Well, so I think we looked at Seven West Media in April, and stock was trading around about sort of 50 cents. And we were very cautious of it, and the rationale was that core media businesses are fundamentally challenged, and they're challenged by the new media at the same time as their content costs are rising and advertising revenues are falling. It also had very high gearing. This proved to be a very wrong between April and September, which saw the share price double, and we were sort of cautious. They came out with a result in August. It wasn't as bad as expected. Management guided to some growing earnings on the back of sort of cost cutting, higher ad spend from cricket rights, expected higher revenues from the Banking Royal Commission, banks attempting to advertise, and also the upcoming election. However, that sort of stock price doubled over a 6-month period. However, what we've seen in the back half of 2019, indeed, it was the back half of 2018, and indeed in 2019, Seven West Media share price has fallen from $1.10 to 50-odd cents. Basically, the underlying fundamentals of the business have been sort of bringing back to earth, in that it's still caught between the jaws of higher content spend, so costs rising, and sort of a weakness in the TV ad market. The banks, whilst they spent a little bit more on advertising during the Royal Commission, probably not as much as I think Seven was expecting. So that's gone from a bad call to an accurate call, with Seven West Media just gaining by 1% over the entire period versus the ASX 200 up close to 11%.
And with a lot less volatility on the ASX, surely.
Yeah, with a lot less volatility, yes.
Now, if we look at the overall strike rate for 2018, I think it's improved since we've had this first quarter or first reporting season in 2019. So what are the numbers coming out to be? So
it's actually surprising. We're quite pleased with it. So the strike rate improves to about 71%. That's getting them right, with one hit moving to a miss, and two misses moving into sort of positive territory. A couple of stocks, one stock which was a miss is now in the Medibank Private, now sort of roughly matching the index.
Okay, so there's some good numbers there. 71% is great in anybody's book, and the whole point of Torpedo Tuesday was to avoid the companies that could blow up portfolios or have a torpedo sent to the company and send the portfolio dragging down. So 71% is a very good number there and a good recap.
Yeah. And I mean, one of the hits that moved to a miss. I mean, what we saw was, I was quite surprised. Beaver Energy was previously a hit, but after recovering 40% in 2019, after signing a deal with Coles to supply their petrol stations, that was really surprised the market, given it was sort of very well-known poisonous relationship with Coles and Beaver, and that deal seemed to be struck very much in sort of Beaver's favour. So that was a new IPO. Had a very tough start to its listing in 2018 after downgrading earnings, but then sort of coming back in 2019.
So that's it does tell us that the market's still moved. There's still lots to, but with a 71% strike rate, that's a good reason to keep the Torpedo Tuesdays going and listening in.
Thanks, Jeff. Yeah, I was actually quite surprised at how that went, but there's always misses, a lot to go along with the successes.
Very good. Thank you very much, Hugh Dive from Atlas Funds Management.
Thanks, Kirsten.